implications as well. There is much concern or confusion rather about the new and the old tax regime. Basically, individuals have the option to choose between old and new and keep switching between old and new. Only in the event you don't exercise the option, the default becomes the new tax regime. Because many of you youngsters would be very happy to do your own savings instead of being told by the government that if you have to bring down your tax liability, you must save here this much, you must save here this much, and you must save here this much. That is cumbersome. That requires a lot of activities and planning and maintenance of documents, etc. You might decide, I will pay a lower tax. Let me have more disposable income in my hands, and I will decide where to put my money. So, and more importantly, you can make the switch every year. You can switch to the old this year, go to the new next year, come back to old the following year, and vice versa. As long as you don't have business income, you basically can make the switch any number of times, which is not the case for businesses. So this new tax regime and the old tax regime, as far as individuals are concerned, for quite some time will run in parallel, and the government clearly wants many people to opt for the new regime because that gives them the freedom to choose how they want to save and where they want to save. So in a democratic country, therefore, the announcement made by the Honorable Finance Minister puts the choice in your hands. And lastly, very quickly, the capital expenditure of the government is going up. It has gone up by almost 3 times in the last 4 or 5 years. And naturally, the allocation to road transport and highways and railways, interest-free loans to the states for undertaking capital expenditure. Some of it is subject to tied conditions, etc. And for retrofitting refineries to meet the green energy criteria and emission criteria, etc. And we all know that capital expenditure has a much bigger employment multiplier than tax rebates and tax cuts given, putting more money in the hands of consumers. Overall, the quality of expenditure has been rising, capital expenditure share, and there is a concern that the fiscal consolidation of the government is slower than what would be desirable. But we would like to point out that in the last 16 years, India's public debt to GDP, both central and state governments and public sector enterprises put together, has gone up only by 3 percentage points compared to many other countries. So our public debt profile hasn't really deteriorated in spite of the pandemic. I'll skip the section on green growth and leave you with the last few slides on how we see 23-24. I would encourage youngsters to pick up the economic survey and read preface, chapter 1, chapter 2, and chapter, especially if you don't have time, read chapter 3, 1, 2, 3, and then chapter 6 as well on the social sector. So basically, we talk about the medium-term outlook and the state of the economy in chapters 1 and 2. In the second decade, 2011 to 20, India was hobbled by financial sector stress and corporate balance sheet stress. Both of them now got repaired. Corporates have deleveraged in general. Banks have better capital and also better appetite to lend. Therefore, the credit to GDP ratio gap will close. It is negative, which means actual credit to GDP ratio is well below trend. It was well above trend in the first decade. We overextended credit. We had to pull back in the second decade. Now it is time for the financial cycle and the investment cycle to come back in the third decade. That is what is going to happen. And credit growth is indeed picking up across various sectors, also to industries. And therefore, we are seeing that in the data, consumer durables or industrial construction goods and manufacturing in the current financial year, growth is healthier than in the previous years. If you look at the private corporate sector, 10 out of 10 sectors have invested more in the first half based on bottom-up data than they ever did in the previous year as well. And in terms of contact-based services, tourism, hospitality, they are also coming back very, very rapidly and reaching levels pre-COVID. And the infrastructure capacity, if you look at where we were in 2011, 14, and where we are in many sectors, the infrastructure capacity has doubled. In railways, of course, because much of the railway track kilometers was laid previously, but adding 8,000 kilometers in the last 8 years is a big achievement, considering the fact we took 60 years to do 59,000 kilometers between 1951 and 2011. So we predict the Indian economy would grow in a range between 6 to 6.8% in the coming financial year, with the point estimate being 6.5%. That tells you that we do expect that there is a bigger downside risk than upside potential to this number. Global uncertainties, we are reminded every day with the US-China tensions, with what is happening in Ukraine, and with the earthquakes, etc., that we have heard about this morning. So there are many uncertainties. Therefore, downside risk to the estimate of 6.5% is higher than the upside potential. But our numbers are well within the global ballpark. We expect on average in the remainder of the decade, growth to be at 6.5% per annum in real terms. And therefore, in the long run, what we need to do to continue to grow steadily or even increase its growth rate, we have to attend to reform areas in this. I will stop expanding on this in the interest of time. My apologies if I overshot. So I will be able to expand on what India needs to do when we have a panel discussion and Q&A. Thank you very much.
Thank you, Dr. Nageswaran, for that comprehensive view of the budget and the economy. As Professor Nageswaran said, one of the key premises of the budget is go heavy on capital expenditure. Now, for the benefit of the students, how capital expenditure works to boost the economy is, I mean, there was a paper written some years ago by NR Bhanumurthy and Sukanya Bose, which calculated how the multiplier effects take sort of percolate through the economy, which sort of arrive at the conclusion that every rupee of capital expenditure produces a multiplier effect of 2.45, and every rupee of revenue expenditure produces an effect of 0.99, and every rupee of transfer produces an effect of 0.98. But when there is a fiscal constraint, which means that you cannot borrow too much, which means that your fiscal deficit will go out of whack, you have to restrain yourself, and you can only raise so much of money, or you have only so much of money. So you're choosing between revenue expenditures, transfers, and capital expenditure. So Finance Minister Nirmala Sitharaman has, for the past 2 years, sort of been pushing capital expenditure, which the expectation is that it will crowd in the private sector investment as well. Now, that paper also said that when you have fiscal constraints and you are boosting capital expenditure at the cost of revenue expenditure, the multiplier sort of comes down to 1.99. So I have a supplementary question to Dr. Nageswaran to start off with. Are you expecting, do you have any estimates on how this capital expenditure will play out in the economy and how it might boost?
I think you have, in your own remarks before you post the question, you have covered all the angles to it. There's nothing much to add. I mean, the expectation is that, first of all, yes, you are right about the multiplier in general, and the multiplier effect, a number coming down when there is revenue expenditure pullback, etc. So the hope is that there are 4 or 5 ministries or sectors, road, railways, and also petroleum and natural gas, and then states. There are 4 or 5 ministries plus the grant to states. These are the ones that are expected to drive the capital expenditure. And naturally, apart from this, I also showed that 10 out of 10 private sector areas also have increased their capex in the first half of the current financial year compared to last, or for that matter, the year before. So, and then we have also seen in the last few years, if you look at the RBI's monthly state of the economy, which I hope the students are reading every month, RBI's monthly state of the economy also show that the real estate sector is coming back, and construction sector is one of the bigger employment generators. So I think all these 3 things put together will not only boost the employment, because it has been hobbled employment generation. If you look at the EPFO data, this year the net additions to EPFO are running at a higher rate than in the previous years. And also the urban unemployment rate, which comes out every quarter, and we have data until September by the Labor Ministry, is also showing a declining trend. So there is already a labor market recovery, but we expect these things to accelerate them. And also, in general, our hope is that infrastructure spending creates a better base for potential growth, so that the actual growth, when it picks up, we are able to run with higher growth sustainably for a longer period than before. Because in the past, whenever India hit a higher growth rate, soon it became a case of overheating. Higher current account deficits, higher inflation, and then currency depreciation, etc. Hopefully in the next cycle, because of the amount of attention given to infrastructure and ease of doing business, etc., hopefully we can run with the cycle much longer than we could do in the past. Back to you.
Mr. Joshi, I'm coming to you with the question where Dr. Nageswaran ended. That one of the biggest employers is the construction sector. In fact, the SECC survey, I think, had found that about 50% about more than 80% of India's labor is casual labor. And, a lot of them are employed in the construction sector. But even construction sector, increased mechanization is reducing the number of jobs if you look at the per rupee invested. How do you think the capital expenditure, the technological intervention, the productivity, which comes because of technological intervention, which replaces jobs, and the capital expenditure, how do you think this equation will work out?
Well, I think you are right. The construction sector is becoming more tech intensive. I think that's the case with the entire economy.
Exactly.
So I think to produce a unit of GDP, you need less and less people. So I think but construction, I think, still remains one of the most labor intensive activities, which can suck low quality labor which come out of agriculture. I think the other segments don't have that ability. I mean, they need more training. I think the rural construction particularly can suck in the kind of labor which is an excess supply in the system right now. So I think that way it does support employment generation. I think probably construction generates the same amount of jobs as the manufacturing. Manufacturing has a higher share probably in GDP. So I think, sorry, I think the other part of your question was, so I couldn't.
I was asking that now, so earlier, the number of people required, number of workers required per project was a certain number, and now it's much lesser than that because of technological intervention and mechanization.
Yeah, sure. So what this infrastructure is going to do is, I think I just wanted to add one or two more things to your previous question also. One, I think there was an RBI study also, I think, which pointed out that the central government capex has a higher multiplier than state government capex.
That's true.
So this is more effective than the state government capex. And I think in addition to that, I think we are trying to promote manufacturing activity in the economy. I think, and we haven't been successful for last couple of decades, to push manufacturing up, and that requires infrastructure. So I think from that perspective also, so this is going to complement that activity. Now, if they have higher multiplier effects, I think it's going to somewhere spill over to the job creation also, I think. So that's the route. Rather than directly employing so many people in construction, creation of infrastructure itself will spill over to the other segments and generate more jobs. How much, I think we'll have to see, because the technology is moving extremely fast. I think it's not so easy to second guess. But I think what we find is that, yes, I think through multiplier effects, you can create much more jobs. Now, the issue is, I think there are several issues with what kind of jobs will be available, whether you'll have enough people there or not, but that's a different question.
That brings me, Mr. Joshi, again to you. Does it mean that, like Dr. Nageswaran said, a lot of rural employment is expected to be deployed in the PM Awas Yojana and other activities elsewhere? You think there is going to be a competition for these low-level workers? Because we've been trying to move workers from the farms to factories for a very long time, which has not really happened. In fact, in the pandemic pushed a lot of them back to the rural areas. And one of the things which sustained them in their homes was MG and REGA and other schemes, right? Over the past couple of years.
See, I think the way I look at the Manrega scheme is that it's a social safety net scheme. I think you deploy it when there is requirement. Otherwise, it should not be the default option that you keep creating jobs through Manrega. I think creating jobs through other asset creation schemes like housing, etc., I think are much better option. In case there's still demand for Manrega, then you deploy it. Otherwise, I think, as you rightly said, you'll be competing unnecessarily. It should be used as a safety net scheme only. And depending on requirement, you can ramp it up or you can ramp it down.
Right. Where, Mr. Bhal, I'm just coming to you in a moment, but I want to just stay on this particular point for a moment more, because Dr. Nageswaran, you yourself have written before that MGNREG has remarkably evolved to become a smart choice for household asset creation, right? And they have a positive impact on productivity and income, and also it affects migration. It stops migration. So, what is your view on that? I mean, Mr. Joshi is saying that it should be used only as a social sector, safety net.
I think largely speaking, he's right. It just so happened that over the years, and of course, let me also add that some people think that bulk of this own land, own asset creation being used as one of the areas of compensation under the employment guarantee program. Some people think it is subject to misuse and abuse. And but however, what we had done in that paper is to cite the study by the Institute of Economic Growth, which did a formal study and said after the improvement in the share of NREGA payments going to own land improvement, there was an improvement in agricultural productivity as well. So there is definitely a positive impact, that it is turning out to be not just a stressful period compensation, but also turning out to be actually a capital expenditure program for rural India. But if it is indeed the case that it is happening on a pervasive basis without being abused, then there is a need to relook at what exactly the program design is, and then maybe come up with some tweaks. But I think I agree with DK, who's a good friend. I think it should be predominantly used as a safety valve.
Okay. Mr. Bhal, a few weeks ago, a couple of months ago, actually, Morgan Stanley came out with a report which said that the next decade is going to be India's decade, and which is pretty much what Dr. Nageswaran also has said in his economic survey. And one of the things which that report said was that this is India's decade, and underpinning it would be digitization, demographics, decarbonization, and deglobalization. Now, one of the things they also said is that structurally, raising wages does not work for India. It says that for India, a policy to boost profits and then investments that create wages appears to be a more reliable approach to generating higher growth. And this was, if you would remember, it was a very famous debate between Professor Amartya Sen and Professor Jagdish Bhagwati, for the benefit of the students as well. A few years ago, there was a major debate on how we should be approaching growth and what should propel growth. Mr. Bhal, what is your view on this?
See, wages in India will definitely go up. See, the whole disguised unemployment which is there both in the rural areas and often in the urban areas, this has to go for the productivity to rise. You just can't keep adding thousands of people to produce the same output. And the whole trajectory should be to move people out of agriculture into first labor-intensive manufacturing and then into higher value manufacturing. there the trend has to be increase in wages. What they get in agriculture, when they're working in hordes in the same farm, it has to be more in the manufacturing sector. Firstly, into low-skilled manufacturing, and then into high sort of value manufacturing. That's been the trend which has followed all over the world. I mean, the whole process of economic development is people moving from this dualism, moving from agriculture to manufacturing to services, and there the wages have to increase. This process of trying to keep down wages will not work. As it is, 90% of our workforce is in the unorganized labor, only 10% is in the unorganized labor, which is the sort of pampered lot. But this government is also, with tweaking those labor laws and putting it under this four pillars, four boxes, is doing its best to sort of work truly on both sides. Save the wages and the social benefits to labor, and also provide some sort of comfort level to industry. So it has to be a bit of a trade-off, and you cannot grow by keeping the wages low and pushing more to wages. No, that's not my line of thinking, and I would like to argue against that.
Do you think we have the luxury of time? Because a lot of people have argued that our demographic window is shutting fast, and we are not skilling people fast enough. We are not producing jobs, generating jobs fast enough, and matching the two. Do you think that's the case?
See, skilling is a very dark box. There's no one-to-one correspondence between the number of skilling programs and the output you get. If we give an example, it's like playing tennis. You're playing tennis with your coach. You keep losing. Then one fine day, you start beating your coach. Similarly, that's the way with skilling. Once you reach a certain level of traction on the ground and you become a sort of semi-skilled or skilled country, suddenly you'll see productivity going up. And, things are happening in the country. Now, earlier in Delhi, when you were looking for a plumber, you didn't know where to go. Now with agencies like, various agencies, urban company and all, they're certifying and skilling, and everywhere, there's a plethora of schemes for skills. Carpenters and what have you, everyone is sort of getting skilled. So India is on the path to being a sort of skill intensive thing. It is taking time, and suddenly one of these days, you'll get that trajectory. You'll start beating your tennis coach suddenly, and then things will happen. There's no one-to-one correspondence between right now, the skilling programs and the output they produce. But skill is the way to go, and I'm sure we're going on the right path.
Right. Dr. Nageswaran, there is a lot of hope on the public digital infrastructure we are creating, and a lot of hope on how digitization would be driving growth for the country. Now, in the past 15 months or so, the TRI data shows that internet connections have not, penetration has not grown as much as it was growing earlier. Now, there is some amount of base effect, but we know that the penetration is not desirable enough at a level that is desirable enough right now. And one of the reasons for that is the entry-level smartphone prices have increased significantly. Now, there seems to be pain at that point of the price point, right? So we know that probably inflation has moved up structurally. If that is the case, have wages also moved up structurally, and will people be able to afford this and participate in the digital revolution as much as?
I mean, that's a very thoughtful question. And I was not aware of the fact that the prices of smartphones at the entry level have gone up, and I'll check that. Thank you for that information. That said, your question about wages is separate. Yes, in the last few years, you can say that real wages have kind of been growing very flat, pretty much close to 1% or so, if any. But I think in the organized sector, of course, real wage growth has been positive in general. But we must also understand that in the last 2 years, because 2-3 years due to COVID, the government also has been supporting population with a handout or transfers in kind as well, not just, which obviously reduces the need for them to use their disposable income. So if you adjust for that, so we don't do a proper adjustment of transfers, and we don't have the data and how much transfers, especially in kind, for which people don't have to pay, boost their overall disposable income for other areas. For example, if you look at the health data, earlier, 64% of health costs were borne by the family that had to undertake the health procedure, let's say, or even a normal outpatient visit. But today, in general, the out-of-pocket expenses related to health have come down from 64% down to 48% because of the Ayushman Bharat programs, etc. So we need to account for all these factors when we say real wage growth hasn't kept up and therefore purchasing power has gone down, because some of the things you don't have to purchase anymore, you're given. So that is one part of it. But data costs in general have come down dramatically in India. And the public digital infrastructure, the way it is allowing the formalization of the economy, even a skeptic newspaper like The Economist had to concede that India is indeed formalizing in one of its articles in recent couple of weeks ago. And we see that in the GST data. I'll give you the information. About 80% of the GST taxpayers are migrated taxpayers. That is, people who came in from the previous pre-GST regime. And the average tax they paid is about 4.2 lakhs. But the balance 20% are new taxpayers in the GST system, and the average tax they pay is 1.1 lakh or 1.13 lakh per annum. And these must be, therefore, naturally much smaller than the average size of the migrated taxpayers, which means much of the micro and small enterprises are now becoming part of the formal economy. And if you look at the article that I co-wrote with the young IRS officer, DP Mishra, 2 weeks ago in Mint, digitization and GST have grown in tandem. So there is a formalization that is happening that is helping many micro and small businesses be able to expand their market opportunities as well as financing options. So I think digital infrastructure, and I don't have a quantitative estimate to back my statement, but I would venture to guess that given the fact that it has been around for 5-6 years, starting from the biometricity to Jan Dhan Yojana and then to the vaccination, COVID, and now to account aggregator, etc., and DigiLockers, FASTag, you name all of them, and GST. I think we are probably adding about 30 to 50 basis points to annual GDP growth because of the higher efficiencies created by the digital infrastructure. That is what gives me confidence about my medium-term growth estimate of 6.5% for real GDP for India. The financial system repair and the digital infrastructure put together, in my calculations, are adding anywhere between 60 basis points to 100 basis points to average real GDP growth for India in the coming years. Back to you.
Right. Mr. Joshi, one of the thrusts of this budget has been, and Dr. Nageswaran skipped that slide on green growth and the green economy. And clearly, there is a political, geopolitical angle to it where, as developing nations, we've been asking for more money, and that conversation continues. But what do you think? How are we going to adjust to this new paradigm where you have a target of net zero and you need to, I know that there are incentives, there are other schemes in place to move to green energy or green energy transition, but on the ground, we do not see the kind of speed at which this transition should happen. What is your view on this?
Well, this transition will be slow, I think, for sure. Let me address it from two aspects. One is the food economy. Food is the first,
right?
And it's very critical for India. I think agriculture is still a large part. A lot of people still dependent on agriculture. And if food economy gets hit, I think it has repercussions. And food is what is very, very sensitive to the climate change. We already saw that. I mean, in March last year, the heat wave struck. The size of the wheat grain reduced, and you lost 5 to 7 million tons. And the consequence of that is that you still have double-digit inflation in wheat right now. But I think I'll give you a counter example also, just to switch the focus to the budget. I think we also saw this year that the onions, there was a big hit because of excess rains in October. The Maharashtra and other onion growing regions, they were hit very badly. Production was hit, but the market price did not spike. And the reason was NAFED had about, I think, 25% of the onion coming into the market was from NAFED. So, which essentially means that you'll have to keep more buffer stocks, more warehousing. These are also things that will allow you to mitigate the climate change is here. I mean, you can't, you have to live with it. So, but you will have to focus on generating more crops which are weather resistant. So all these activities will help you in mitigating. So it becomes, and money for that, I think somebody has to pay, and government will have to play an important role in that as well. So this is the agriculture part very briefly. And coming to manufacturing, coming to the other angle, which is manufacturing, which we are now trying to promote. India has grown by through its services sector. So we transitioned from agriculture to services, and manufacturing it retained its share in GDP, but did not become a leading engine. Now what is happening is you're creating infrastructure. What do you need for infrastructure? Steel, cement. They are highly carbon intensive. You're creating manufacturing activity, which is in general more carbon intensive than services. So your structure of the economy, if it plays out, is going to move towards more carbon intensive. And now, and you also have the targets. So it becomes very important for you to address them. And on top of them, countries like Europe, etc., they are talking of tariffs, etc., on products which have more carbon footprint. So I think there is no way out. I mean, it might be the fault of the West, or I think they must be contributing more to carbon. They are contributing more, but the reality is that you have to adjust to the new paradigm. I mean, which is there. So we have to move on the climate issue also. That is why budget has made a few beginning, and I think you'll have to continue to do that. I mean, for the smaller enterprise, particularly, the larger companies can tweak their processes, etc., etc. But the smaller ones will require support. So green finance for MSME, etc. These things could be coming. And finally, I think the greening, if you look at the PLI scheme, I think my colleagues in research did some work. They found that the 70% of investment that will take place will have a green angle to it. I mean, so it's not the budgetary allocation alone. There are other mechanisms also which are pushing manufacturing towards greening, I think. So I think that's I might have taken that. It's a little long answer, but I thought I will try to address the agri and the manufacturing.
In fact, there's a very interesting research which came out recently relating to climate change. And I found it very fascinating because it was a research on dragonflies. And it said that the heat is causing dragonfly wings to become shorter. And because they're becoming shorter, they're flying less distances. And on an average, a dragonfly eats about 30 mosquitoes a day, 30 to 40 mosquitoes a day, which means that the number of mosquitoes which will be eaten by dragonflies will be less, which means the incidence of dengue and the incidence of other health mosquito as a vector will increase, which is going to add to your health costs at some level, at least, which I found quite fascinating.
If I may add just one more angle to that, I think there's a study on agriculture which says that with every 1 degree increase in climate, the pests become more strong. I mean, so the pest attack also becomes. So there is ample research to show that that I think that there is an adverse side to the climate change. And
are we cognizant of this, and are we doing something for this, Dr. Nageswaran? This kind of headwinds which are completely unexpected.
No, I think that's an excellent question. I mean, I think are we as humans? I think we are not that well equipped to really handle many unintended consequences.
No, I mean institutionally, are we thinking about it in the government and approaching it
from the point of view of understanding that warming can, as DK pointed out, that agricultural pests can become stronger. But in general, we know that tropical places have far more incidence of malaria or dengue, and if warming is going to further raise the probability of these things, these infections happening much more frequently or in much greater numbers, there is indeed an awareness, and that is why I think the Swachh Bharat program was launched, because ultimately it starts with sanitation. But we also, and much of it also has to happen at the household level, and that is where I am concerned about the fact that if the National Family Health Survey number 5, the obesity levels in adult Indians across rural and urban India have gone up. Obesity level has gone up. And I think that is what makes us, we may not be able to prevent some of the external hostile forces acting on us, whether it is pests or mosquitoes. But if you have made your body more resistant, then you may be able to handle far more infection than somebody else who is not equipped to do so. So what are we doing to improve our own immunity systems in terms of lifestyle, eating habits, physical activity, etc.? So I think there is much that even private sector or households have to do by themselves in order to prepare ourselves for these kinds of questions that you, and I would love you to send me that research on dragonfly wings becoming shorter. I mean, this is a classic case of, we just don't know what are all the unintended consequences we have unleashed.
The answer to that is clearly research and development, and I don't think we are investing enough in that. What do you say, Mr. Bhal?
Yeah, see, that's a well accepted fact that India's expenditure on research and development is not enough. And there's been a lot of sort of brainstorming about it, and all the best of scientists and the chief scientific advisor have applied their mind. And somehow, it sort of hasn't taken off. So now, with our strong emphasis on all the startups and innovation and technology and how all this digitization and innovation will lead India to a higher growth path, I sincerely hope that this expenditure on research and development, which has been a kind of Achilles heel of India's corporate sector, will be improved and we'll move on to a higher sort of expenditure on R&D.
Right. I'm quickly trying to squeeze in one more question because I think we are about reaching time, 7:30. I think the students want to start open up for questions. But quickly, Mr. Bhal, what do you think is we say global headwinds, but what do you consider as the biggest risk facing us, external risk facing us? I'm putting the same question to each of you.
I would think it's this Russia-Ukraine war. I only hope it doesn't balloon into something much bigger and, spikes energy prices and vitiates the sort of relationship with the other developed countries. That I think is a bit of a sore point at the moment. And I still think that Russia-Ukraine thing is the biggest headwind we might face.
Mr. Joshi?
Well, I think apart from Russia, Ukraine, I think if you look at the global leverage, I think S&P has done a study which shows that the debt to GDP ratio across the world is 350% of GDP, which is 25% higher than what it was during the global financial crisis. So you have a scenario where you have debt repayments, and the cost of debt is rising. Interest rates are rising. And your ability to pay the debt will reduce because growth is going to slow down. So there is always a risk of some accident somewhere. So I think we have to keep our eyes open. Nobody can predict a crisis of anything like that. But I think this is a fertile ground for accidents. What will happen, I don't know. But I think there would certainly be some defaults at this. You can't, but whether it will be systemic or not, I think you need to keep your eyes open. Now, in this scenario, running a current account deficit, as I think Dr. Nageswaran had also written in his economic survey, if you have a high current account deficit, I think then you depend on somebody else to finance it. And in this environment, the risk first comes to your external vulnerability. So I think you have to be a little watchful.
And also, is that, not only that, there was increase in changes in some of the taxes, which was one for LRS scheme and one for the angel tax and all that. Is it also one of the ways to sort of prevent, quick movement of currency out and in and out?
Well, this question is for Dr. Nageswaran.
Dr. Nageswaran, yes.
Yeah.
Oh,
Dr. Of course.
I thought DK would save me by answering it. Please, DK, go ahead.
No, please, Doctor. Sorry, yeah, go on, please.
Well, I think my 1 cent on that is that I don't think in case of accident there is anything that can protect you. But yeah, you can have some cover, but I think that's it. You have to keep your fundamentals right, and I think the budget is, by keeping a lower deficit, is actually working towards reducing your current account deficit, because fundamental identity of economics tells you that it does spill over to the current account at some point in time. I mean, so.
That is a good deflection. Dr. Nageswaran?
I think when you talk of risks, obviously, what happens to geopolitical conflict in Europe and then and the ramifications on oil price and global supply chain disruptions, that's definitely there. And DK pointed to structural debt ratios. But I think the fact is, in general, risks that we are aware of will not be the ones that will hurt us.
Right.
So I will use the Rumsfeldian language and say it is really the unknown unknowns that will hurt us. And that by definition is unknown. But I think DK's point about the debt and Mr. Bhal's point about the Ukraine-Russian conflict and the implications they have are the ones that we flag in our economic survey as well, because global factors are going to be important. But as far as the question that is about LRS, I mean, it is not so much taken as a preemptive measure against current account deficit, but clearly there is a case that, and it's only a tax collection at source. If you have a taxable income, which is well above the kind of levels that you would be having to be able to send that kind of money out, you can always claim it back and set it off against your overall tax liability.
Right. But it also hits a lot of people, who middle-class people who are sending their children abroad to study.
It is not including, it excludes health and education completely.
Right. That's true.
It does.
Yeah.
But I must compliment you, Mr. Dinesh Narayanan, for excellent moderation. I haven't seen such an intelligent moderation in a very long time.
Thank you thank you very much for the compliment.
Completely agree.
Nageswaran. Well, I'm lobbing it back to Shantanu and his team and Ma'am Bansal for some questions from students. Yeah.
Yes. We thank our panelists and moderator for such an informative and engaging session. Our panelists have shared their insights and experiences. And now it is time for you, the audience, to come up and show your knowledge and ask questions to engage with the panel directly. Please raise your hand if you have any question, and Team Niveshak will try their best to ensure everyone has an opportunity to ask. The floor is open to you, friends. Yes, so we will begin with Karnika. You can go ahead. You can unmute and ask your question.
Thank you. First of all, I'd like to thank all of you for such an insightful session. I have a question for Mr. Anand Singh Bhal. Sir, India's trade deficit is around $220 billion for the months of April to December 22, and exports dropped around 12% in December itself. Given the global economic slowdown, do you expect the exports to drop further, or do you think this is an opportunity for our nation?
See, my knowledge of the trade scenario tells me exports have been doing reasonably well over the past 1 year, with a very strong thrust given by the Commerce Minister Piyush Goyal and the Ministry of Commerce. My reading of the situation has been commerce has been doing reasonably, the exports have been doing reasonably well, and they'll continue to do so. And as far as imports going up, one should not bother a bit too much, because a lot of these imports are also, in a way, essential imports which will help the manufacturing sector in the country and which will help our exports also. So there is a cause of concern a bit about the current account deficit, but the way things are, our exports are on a fairly strong keel, and I don't see it as too much of a concern that our imports are rising too much. I think the CA will be better able to handle this question, Mr. Nageswaran.
See, basically, if you look at the combined export of goods and services in the first 9 months of the current financial year, they're running at a rate which is 16% above the previous financial year, April to December 2021. But of course, in the last 3 months, you can say merchandise exports have kind of tailed off. If you just look at the last 3 months of October to December. And there is clearly the case that the $420 billion of exports, merchandise export that we achieved in 21-22 was largely on account of a global rebound from the contraction of 2021. And in general, before that, our average exports were somewhere between, $250 to $350 billion. That was a step up. So to sustain that kind of merchandise exports, India needs global growth to help it. Because when it comes to a global slowdown, those who are competitive in terms of cost and quality and productivity will do better. and the marginal exporters who benefit when the rising tide lifts all boats will be the ones to be, cut off from the global supply chain. And India, I don't know yet whether we have crossed that point. But what is going to help us is, of course, the fact that if there is a global slowdown of meaningful proportion, and that is what I've been emphasizing in my interviews and articles and in the economic survey, a global slowdown is what the doctor would order for India. Because our exports may not necessarily do all that well, but I would count the benefits coming from a slump in commodity prices and the relaxation of global financial conditions, monetary tightening, etc. So the positives would outweigh the negatives. So I think we need to continue to work on last mile competitiveness, quality, market, productivity, etc., for us to be able to move up the export value chain in a sustainable manner. At the moment, we did very well in 21-22, but let's wait and see where we end up for 22-23. If we are able to achieve even on about $335 billion in merchandise exports in the first 9 months. So there's a pretty good chance that, you end up close to 400, which is only about 5% lower than, let's say, last year. And that would still be a good achievement in the current circumstances.
Thank you for your answer, sir.
Who's next?
Mosmi ma'am can go ahead with the question.
Good evening, everyone. So this is Mosmi Bhattacharya. So I'm a faculty of IIM Shillong. So just a query. So with regard to the annual tax from the non-residents, so anything with regard to the geopolitical tension or something which is acting behind with regard to this annual tax which has been proposed to be charged non-residents, which so far was not there. So just a little bit understanding with regard to that. And how it would bring about a change with regard to the cross-border transactions, the raising up of money, the startups. So once there was a focus of more startups, so now if that is being imposed, so how do these capital flows would happen and how that would affect the cash flow scenario of the startups? So anything which might be working behind, so just an understanding.
Well, I mean, I don't think there is any geopolitical angle to the angel tax levied on some foreign investments as well. So, but as far as I don't think so. I don't think there's a geopolitical angle to this. But we definitely need to wait and see what kind of implications it has. And at this point, I think it's somewhat premature to speculate on the implications if it doesn't affect the majority of the people who are able to justify the valuations, etc. And the DPIT also clarified that it doesn't apply to those which have already been, accepted as startups in their, technological startups, etc. So we need to wait and see whether this measure was some sort of a loophole plugging measure that was implemented and whether it would have a broader spillover effect or not. It is somewhat early for me to comment on that. Maybe DK has something to add from the market feedback or whatever.
No, sir. I also am actually I'm pretty ignorant on this issue. Let me admit, I haven't looked at it.
So basically, there are no angels and demons. We have the next question.
Okay, and another thing, sir, which actually comes out from here with regard to AIF, the Alternative Investment Fund Category 3. So a lot of things that are coming up that there is no clarity with regard to the carry forwards of the taxation aspect. And then REITs, Invest IT also comes into the picture, which at a point of time, those high dividend yielding options. So why suddenly this lack of clarity, which is there for type 1 or type 2 AIF category, but not that clarity with regard to the AIF category 3. So maybe which comes out of this entire thing, but that was also which was not quite clear in the budget. So I thought getting hold of such an esteemed speakers, so let me take that risk of asking you.
I mean, I appreciate you raising this question, but I don't have the information off the top of my head or on my fingertips to be able to provide you the clarification. Okay. So I didn't come prepared for such a minute financeable provisions.
Okay.
So you could drop me a mail. I'll forward it to the relevant people and try to get you the answer.
Okay. Thank you, sir. That's for my side.
Yeah. Thank you for the question. I think we have time to squeeze in one more question. We got 4 minutes to go. And
yes, sir. Yeah. So next question is Pushpa. You can go ahead.
Um, so my question is for Mr. Joshi. So with China's lockdown easing, we expect the industrial activity to pick up. This will increase the demand for the crude oil at a global level. So how big of an impact can we expect it on the crude oil prices? And also what effect do we expect on the rupee for this demand increase in demand?
Well, I think our base case assumption is that S&P's expectation is that China will rebound to 4.7. I think IMF has recently come out with a report saying that it will cross 5%. So it actually depends on the size of the rebound. I mean, if it is very big, of course, it will be disruptive because China does consume a lot of commodities, etc. So it is, I think the global prices are sensitive to that. But there are many other moving parts, I think, including the Russia-Ukraine conflict, what kind of stance OPEC will take. So oil price is now actually quite, it's not just dependent on China, but it can disrupt the base rate. So our expectation is in 2022-23, oil will be close to 90-95. I think that's the average. And for next year, I think we are expecting it at 80 to 85, with China growing close to 5%. So I think that's the assessment. Now, I think it's anybody's guess what else can influence it. But yeah, I think China's rebound will help us a little bit, because what happened because of China's slowdown is that we kept on importing from them, but they were not importing from us. So I think in 22-23, Chinese imports from India have slowed down. So the trade deficit has bloated. So if China starts growing, they will again start getting those stuff from us, like raw materials, etc., which we typically export to China. So maybe it will help in reducing So what's going to happen next year is it's that India did pretty well in 22-23. It's going to slow down a bit in 23-24. China slowed down in 22-23 or 22 because they shot themselves in the foot because of their COVID policy. The economy went down. China is going to go up. So I think it's going to be positive for our trade deficit with China. So we will end up with a lower trade deficit, because India slowing means we'll import less, and China moving up will mean they'll import more from us. So I think it should be positive for us.
How do you think it will affect food prices?
Food prices?
Yeah, global food prices. Because there is one statistic which I found, one forecast which I found very interesting, that 2025, China is going to be short of 135 million tons of food grain. And one of the reasons why China is trying to shore up food everywhere in the world is that. So that's why I was asking this question, once China starts, because there is also a trend of downgrading of retail consumption, both in China and the US and other markets. I mean, just reading that dollar stores are back in vogue, and that kind of stuff.
There are various explanations but I think what is true is that Chinese consumer has accumulated a lot of savings in the last 2-3 years.
Right.
There's no option to spend. I mean, the lockdowns and the zero COVID did not allow so there is a lot of money waiting to be spent.
Right.
So a lot of money spent on tourism. Where all it will flow, I think we need to watch it carefully. But they will unleash spending, I think, for sure.
Yeah.
Right. I think we have just running out of time. 7:45 it is. So if you would like to stop here, you could. Shantanu?
Yeah, hi. So I would like to come in here, and it was a very fruitful discussion wherein various points were touched upon very nicely, wherein we did touch upon demographics, skills, and R&D. So I just wanted to prepare for education, because a lot of news is there around education, expenditure on education, and although on a total terms there is a marginal increase, but otherwise, there are changes. So a little reflection on that would help us to gain more insight into it.
Could you repeat the question?
Yeah, the question is related to the expenditure on education, actually, the allocation for education.
Right. I think I did allude to that in my earlier remarks. I said allocations don't mean outcomes. And if you can tell me that 1 rupee extra spent will improve some of the problems that universities and the schools face with respect to the quality of education imparted, we would do our best to increase them. I think we need to create this kind of clear thought process in our heads that higher allocations mean better education outcomes. So therefore, then your question then therefore leads to another question. If in earlier years, allocations were better and more, then why is it that we didn't get the kind of outcomes that we were expecting? So I don't think the answer lies in higher allocations alone. Yes, they do matter, but they are not the only part of the story, especially with respect to the kind of issues we face with respect to our primary and secondary education. The answer doesn't lie in allocations. That's the one answer. Second, if you actually look at the fact that allocations by general government, which includes union and state governments, the amount of spending on education has indeed gone up substantially in the last several years. So, but I think we need to think a lot more deeply about what ails the education and the educating process. And it is not just a matter of higher allocations.
That is true. That is true. Thank you for that reflection. Yeah, indeed, we all discuss about the same things often. Thank you.
I think we have come to the end of the session, and back to you guys to wind it up. My thanks to the three panelists. Thank you, Dr. Nageswaran. Thank you, Dr. Joshi, and thank you, Mr. Bhal. And over to you guys.
And thanks to you too.
For the conclusion. Thank you so much.
Yeah, thanks for the conclusion. Great answer.
Team Niveshak would like to thank all the dignitaries and our moderator for this extremely insightful session. It's with huge amount of regret that this session is now coming to an end. And I'm sure that every participant has received a lot of value addition with respect to public policy and the budget that was released this year. We would also like to thank Professor Rohit Dwivedi, sir, Student Affairs Chair, and Professor Vishakha Bansal, ma'am, Team Niveshak's faculty mentor, without whose guidance and support this panel discussion would not have been possible. And lastly, we would like to thank the entire community of IIM Shillong for being an engaging audience for everybody involved. We would request all the student participants to please drop off the call. And if the dignitaries, our moderator, and our faculty could remain for just a couple of minutes. Thank you so much, everyone.